Remember September 2024? Equity markets were hitting new peaks. The India story was as strong as ever. The fastest growing economy even amidst a global slowdown. 5 months later, February 2025, the Nifty 50 index was down 15% from its peak. The mid-cap and the small-cap indices were down almost 20% from their peaks. Why? One bad quarter of corporate earnings. President Trump and his tariff uncertainty throwing off global trade projections. Currency wars, a strengthening dollar and a falling rupee. FIIs selling out of emerging markets. Equity trading volumes dropped, more shorts than long positions. The bears seem to be out. And just like that, cut to 5th March 2025. Stocks are coming back up in green again. Why? This time, the dollar is weakening. Crude prices are falling. RBI has announced a series of liquidity measures. The impending tariff uncertainty has given way to some tariff clarity. Will we finally stop seeing red in our portfolios and go back to happier days? What will markets do tomorrow morning? In reality, nobody knows. Let's see if history can give us something. The last 45 years of Sensex, which is India's oldest index of the top 30 companies, shows us that Indian markets witness a temporary fall almost every year. There were only 4 out of 45 calendar years where the intra-year decline was less than 10%. However, interestingly, even though markets witnessed intra-year declines of 10 to 20% almost every year since 1980, the markets still ended positive 36 out of 45 calendar years. This data tells us two things. One, temporary falls of 10 to 20% have been a common feature throughout the history of Indian equity markets. And two, these declines usually did not last long, with the markets mostly recovering within the same year. Most of the times, the journey of equity investing is a series of squiggly lines in the short term that gets spread out in a linear upward direction as we add more time to our investments. Today's noise, both negative and positive, get faded out with time. In the long run, what matters more is our actions today. Are we saving and investing with discipline? Are we diversifying our investments across asset classes? Are we selling our investments and stopping our SIPs? Or are we taking advantage and adding as markets fall?